Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the Bull versus Bear webinar today, Monday, the 13th of February. Welcome, everyone. Steve Miley on the call for TradeDay.com. Welcome, everyone. We're going to go through our usual regular run through in here today, calendar, what we've got coming up. On top of that, though, as we usually do on our Monday meeting, the shape of the week, okay? What's coming up for the week? Where is the focus for the week? Yes, we are day trading at tradeday.com, but clearly the focus is going to be this week on events further down the line, and that can impact the markets today, right? So I think it's really useful, even as a day trader, to take a look at what's coming up for the week, because then it gives you an idea if today is going to be more or less volatile, depending on what we might have coming up, and that's certainly of importance today. So we'll take a look at the shape of the week, and we'll have a little look back, see what's happened. We'll take a look at some articles from the major news wires in here, the financial market news wires, to see what are the fundamental macroeconomic geopolitical events that are impacting markets right here, right now. And we'll take a quick look at the charts to see where the trigger points are on today's major markets that I know that our traders are trading: S&P, NASDAQ, gold and oil, and a quick look at the treasury market. So first of all, let's look at my trade day recap and outlook in here for last week. So last week we had the prior week, 2 weeks ago, we had that massive week with all that data, central banks, earnings, etc. More of a quieter week last week. We actually had an inside weekly pattern, for example, on the S&P. So the high and low of last week was within the previous week's high and low. And that shows that the markets are consolidating. Certainly a more negative tone. We've got topping patterns on the major US equity indices. I'm going to sneeze now, so excuse me. Excuse me. And more negative tone, little topping patterns, double top patterns, quadruple top patterns, in fact, probably on the major US equity indices. Not aggressively negative. No surprise that we're probably seeing some profit taking from the stronger gains that we've seen through January and into the early part of February in the general risk on. So we've gone from being very risk on for the first part of the year to a pulse towards most of the beginning of last week, and then a slightly more negative tone, probably some profit taking, right? It's probably some position squaring ahead of a big event, which I'll talk about shortly. Last week, so the drivers of this kind of slightly more risk off theme in here. So we saw stock indices set back, and we saw global bond yields, not just US bond yields, but global bond yields rising higher on the back of really two kind of driving forces. One, even though Powell reiterated what people are seeing as a more dovish tone, so we saw the risk on theme initially extend last week. So stock indices initially higher when Powell reiterated views around disinflation, but then subsequently comments from other various FOMC members were of a more hawkish tone. There's certainly a mantra of higher for longer, okay? There's certainly a mantra of, yes, inflation's coming under control, but we're far from done yet. That's certainly seen, and as we've spoken about, if we go and look at the CME tool, remember in here, if we look to the, in a couple of meetings time for June, okay, we're pricing in, if this will respond, we're pricing in up to 450 to 525. This is a higher peak. 500 to 525 with a chance of 525 to 550 into June, and then July we're getting close to an even split between 500, the peak being 500, 525, or 525 to 550. So at least another 50 basis points, maybe from here, maybe another 75 basis points. Okay, so the peak is starting to look higher. And if we look towards like November, we're probably seeing in here, if the peak is the 500, 525, fewer rate cuts now expected. And you can see now almost only just now in pricing in a rate cut at the end of the year for the 13th of December. So the markets have started to take on board this mantra of higher for longer, okay, and no rate cuts, although they're still pricing in the rate cuts, and they're also still pricing in a peak in rates, probably definitely at the moment pricing in to where the Fed have told us, but the Fed are kind of shifting, and we focused on this last week. Citigroup putting out calls for the peak in rates maybe being as high as 6%, so another whole percent higher than we're kind of pricing in at the moment. So and certainly the bond market, if we go and take a look at here on bond yields, and if I pop this one out for more of an interactive, or if I certainly take it, here's the interactive chart. So bond yields, and we'll see this when we come to look at the futures shortly. You've seen bond yields in here, certainly in the last week, start to push back up higher. Okay, she came from the beginning of February. This was after the employment report. Okay, so the reaction to the employment report was certainly that the Fed could go higher with rates. Okay, so we've seen yields. This is the 10-year note. Sorry, 10-year note yield. Seen those push higher, and they pushed higher at the end of last week as well. Thursday, Friday, back up higher in yields, lower in price, higher in yields, echoing, reflecting the fact that the Fed potentially in here are shifting to more hawkish, and that more hawkish message being picked up certainly by the bond market and to a lesser extent by the stock index market as well. So that was the theme really last week. And then also Alphabet shares led the tech sector lower with concerns around, so Google fell, Alphabet fell 10% last week. The reports that Bard, which is the equivalent of the Google's AI chatbot, made a mistake in its public demonstration, and then also the ongoing competition from ChatGPT and also Perplexity in here. So concerns around Google dragging the tech sector higher, and with the tech sector and with those higher yields in here and the shift to a potential more hawkish tone, we've seen a shift to more risk off. Going into this week, there's no real standout events in here. If we go to if I jump to in here to my calendar in here, we've got nothing of note today. Well, if we actually go to the calendar here, the only thing we've got is Bowman speaking in just 23 minutes time. So we have Bowman speaking. If we go and look at the Fed speaker, so Fed speakers in here, it's got the calendar. So by the way, in here, guys, you can see in here, if I just share these with you, this is actually like a library of past speeches. Not particularly useful, but I mean, if you're bored and you want to catch up and think you missed something, you can go and take a look at past speeches. There's a little library there, but also more importantly, the Fed calendar in here tells you what's coming up. Now, if you look at what's coming up in here for this week, it's very light actually. So winding forward in here, because I don't always pick it up on these calendars, right? And I thought that we've got in here Bowman speaking today. If you look at the rest of the calendar, there's hardly anything on the calendar. I thought, maybe the calendars aren't picking it up. If we go to the calendar in here, and I'll share this one with you as well. So you've got the calendar plus the library of speeches, so good resources in here. If you go and take a look at the calendar, there's Bowman today, right? But if you look then Tuesday, Wednesday, nothing. We have Governor Lisa Cook speaking on Thursday, and then nothing on Friday. So it's a very, very light week as well in here. And obviously then running into on the Fed speakers, and then running into next week, we've got the President's Day holiday, right? So but a very light week in here. So on the Fed speakers side, going back to my weekly in here. So, but looking ahead, obviously, clearly, the big important piece of news we're waiting for is the US CPI data. Okay, so we have that on Tuesday. That's going to be absolutely critical. So I'm expecting markets to be relatively quiet today. Expect narrower ranges. Okay, expect probably less volatility and markets to be relatively quiet. Probably a mean reversion today. And as much as I'm negative, if you go and take a look at my daily technical analysis piece in here, you'll see because of the topping patterns, you've got kind of quadruple tops, either double tops or quadruple tops, whatever you want to look at it. We'll look at those again on the S&P and NASDAQ. I'm bearish on both of these. On gold as well, you've got a topping pattern went in, big sell-off, and then broken out. This flag pattern looks negative as well. As much as this is in, but oil was pushed higher, but then we're seeing a retracement this morning on oil. But oil looking more bullish bullish actually. But if you look at these, we're definitely in risk off with respect to these two, with Nasdaq and S&P. And gold in here is actually playing as a risk asset at the moment because of the inverse relationship with the dollar. Okay, so it's not that, traditionally gold's a safe haven, right? But it's been correlated positively with riskier assets, last year and going into this year. So in here, the sell-off in equities has been matched and echoed by the sell-off in gold. But despite all of that, I wouldn't be surprised to see a little bit of a mean reversion day today. So as bearish as I am on these, I think what you might see is just a little bounce back into the ranges and probably not going much above first resistance points. Maybe going towards, just above first resistance towards second resistance points, but nothing more than that. And looking for a consolidation day ahead of. And going back, to where I was, the CPI data. So US CPI is going to be the big standout. US retail sales on Wednesday as well. Just to say that we do have some big data out of UK and Europe this week. So just to keep an eye on that as a back burner. Doesn't always have a big impact on US equity markets and US bond markets and global commodity markets. But we get the UK employment reports. That's obviously a big deal. EU GDP, very backward looking, but nevertheless, big deal. We get UK CPI as well. That's on Wednesday. US PPI is usually a bit of a damp squib, doesn't really do much. Australian employment report, probably not going to do too much. And then we get UK retail sales. So really the big focus on US CPI, US retail sales. But don't forget that UK employment report, that's overnight for you guys in the US tonight. It's very early tomorrow morning in the UK. And then UK CPI as well, and that EU GDP. So the UK EU data is punctuating the US CPI and US retail sales data, where the big focus is going to be this week. So certainly watching that US CPI, all eyes on that. And just going to the chart in here. Remember this US CPI day, if we look back, this was CPI in September, massive failure day. Okay, big range in here. This day, this turnaround day, the sell-off and the rebound, the market, the day after that, I said, I think that's the low in for the market. It was the low so far anyway. I still believe that's the low, the bear market low of 2022. We called that the day afterwards, right? A big turnaround rebound day for CPI that day. This day here, massive day, nearly up just under 6%. Marabuzo, bullish, super bullish candlestick in November. December was a sell-off candlestick, okay, but again, Marabuzo. And then a little bit of a fairly quiet candlestick, the shortest one we've had actually with the January data. So let's see, okay, and we've obviously dipped back down. We've taken out a couple of trend lines, and I'll come back into this shortly in here, but we've taken out a few trend lines. Now and as negative as this topping pattern is, just showing that quadruple top in here. So you've got kind of quadruple top, 1, 2, 3, 4 peaks up there, right? Down through there. As negative that is, the rebound that we've seen in here today, I now feel that, and we're actually above, if we go and take a look at my first resistance points, actually, we're not quite above. No, we're not quite above. We're just short of, excuse me. First resistance, 41.21 and a quarter, okay? So going back to the chart in here, you'll see we're still below that. I wouldn't be surprised for us to go and probe that 41.21 and a quarter level, but fade below the next resistance all the way up here. So, but pushing up maybe just above there and then just consolidating in here. I'll come back to that shortly. Let me finish off what we've got in here. So that's pretty much what I've got in here on the data coming up. All focus on CPI tomorrow. That's pushing me towards a mean reversion day. 5 things to take there. Let's just run through some fundamentals where we've got the ongoing balloon flying objects, UFOs, unidentified aerial phenomena, putting the US and China a bit head to head in here. However, you know what? Markets are not massively reacting in here. Not a massive big deal in here. What else do we have in here? Work from home costs. Talking about that again, not having a really big impact on us. But US stocks are right for a sell-off as traders ignore the reality of earnings and prematurely pricing pools in Federal Reserve rate hikes, according to Morgan Stanley strategies. So they're a little bit more bearish in here. European stocks are nudging higher this morning. Okay. And so, all about you and talking about no major US data today, all about Tuesday's US CPI release. Again, morning bid in here. It's just out of interest. Obviously, big day for you guys in the US yesterday. Super Bowl, Kansas City Chiefs pulling it out of the bag kind of late in the day against the Eagles. In here, this is a little icon, how many wings How many chicken wings are eaten in the US? 1.45 billion chicken wings, up 2%, 84 million wings on last year. Total of 4 wings for every man, woman, and child. And enough to stretch from Kansas City's Arrow Stadium to Philadelphia's Lincoln Financial Field 62 times. Backwards and forwards, 62 times. That's the amount of wings that were eaten yesterday, apparently. There you go. But then they're talking about in here US inflation. There were some on Friday. We had some revisions to the inflation data. Revisions up actually for last year. They do this every year. They revise data. And here it was seasonally adjusted data was revised back on Friday, all nudging a little bit higher actually for the back end of last year. So that's kind of slight interest as well. What else we got in here? How China's balloon sent the US on a hunt for flying objects. I think it's a bit of a non-news story at the moment. It's not really turning into anything significant on the financial markets. It's anything. It feels a bit like a smoke screen in here at the moment. US futures steady going into today. Obviously, inflation. We've seen a dip and a rebound, so up slightly in here this morning. Crunch week for US economic data. Okay, so yeah, clearly. And then this is that report from Morgan Stanley. Nasdaq futures higher. Obviously, the mega caps got hit last week in here, and the previous week on results. And then Google again further lower last week. And oil as setback from we did see a strong rise in oil last week, but setting back in here because of concerns of that whole risk off move that we've seen from last week, flying back into oil. So stock indices in Europe are up this morning between 0.3, 0.4, up to 0.7 higher across the UK, Germany, France there, and US futures in here. Oh, let me just open this one up. We take a look where we are right now. We're up 0.6 on the Nasdaq, having had a quite a negative end to the week last week. A couple of tenths nearly on the Dow, and 0.33% up on the S&P. Already spoken about the Fed. Let's take a look at a few of the charts in here. So, as much as I am kind of almost negative, I do think we've had a decent little bottom put in here. You would argue this is almost an inverse head and shoulders, shoulder, head, shoulder, inverse head and shoulders. Now, if you actually have the upward sloping neckline that's been developed in here, you're not actually through the neckline yet. So, and that's not far off. That's around 41.15. And then we've got that other resistance. What did I say? Like 21, 22 and a half, was it in here? Where are we on my text? 21 and a quarter. So 21 and a quarter, just a little bit further up in here. Right in there. Okay, so the market here maybe pushing up to there, maybe a little bit above there, so it's slightly positive running into today. Obviously those reports were written over the weekend before we had this positive price action, so I think there's a little bit of upside in here, mean reversion, but I'm not aggressively bullish. I mean, for me, this is a real difficult day to trade. I'd rather keep my powder dry, keep it for tomorrow, guys. We're gonna have a big day potential. We looked at the charts there, these big explosive days we've had here and here and here and here on CPI days. Plenty of potential to make some money tomorrow. Let's take a look at Nasdaq. Similar story for the Nasdaq. In here's on the daily, we've gone down to this trend line, holding this trend line. Similar on the daily on the S&P. We've broken the accelerated two, and we've held. And back on Friday in here, you had like a hammer pattern on the lows in here for the S&P. And if we look, didn't really get that sort of semi-hammer pattern, but getting a hammer pattern, breaching this trend line and rebounding above it. And look at the 13-period exponential moving average. This is the Nasdaq. The market pierced down through it on Friday, came back, held it, pierced down through it today, back above it in here. Similar story for the S&P. Look, market's been piercing this 13-period exponential moving average, 13-day exponential moving average, getting back above it in here now. So, and then on the 15-minute chart, you've got this kind of quadruple top, similar on the Nasdaq in here, and now you've got this kind of basing pattern in here. So it's not quite inverse head and shoulders, more like a triple bottom down here, but you've qualified that. You've pushed up through that little peak there. Where's that? 12,409, just got above there. Okay, so now we've signaled that a reinforcement through that level there. So you've got 446 and a quarter on top side, and then 462 and a half. And just going back to my daily in here. For Nasdaq in here, you see we're through 410 and a half in here, so that was important as well. Okay, so we took out 410 and a half already in here, and aiming in here for further. That was 410 and a half there, I think. 409, no, 410, yeah. And so we're up through resistance in here. And for me now, the risk is slightly higher. I'm not looking for big things on the upside, so as much as kind of bigger picture, it still looks negative. I think today mean reversion day is setting up really in there. Let's take a nod to the commodities and then we'll move on and have a quick look at treasuries. So commodities in here, here's oil. So it did a significant sell-off in here this morning, but a strong rebound as well. Upward pressures, really strong week last week. So for me, it all looks like potentially back to the high. We've kind of rejected in here the downside with the dip and the bounce today. If we go into the 15-minute, there's the dip and the bounce in here. So a strong up week last week. I'm going to get rid of all these old drawing tools in here. Okay, so you can see in here dip and a bounce in here this morning. I think aiming back to the highs. This uptrend for me is very much intact. If we take the trend line not off the actual low, so this one in here is a bit redundant. If you take this one in here, right? But if you take it off of in here, I'm going to get rid of that. Just bear with me. Okay, if we take it on the secondary low, so this is often useful. You get this, sometimes the trend, properly establishes on the secondary low. And if I extend that one out as a ray, then look, the market's kind of come down once, come down again to kind of approach this and now impulsively moved away. So I think back to the highs on oil, the high there is 80.33 and then up through 80.33, going back in here. Yeah, it could quite easily be back up towards this area here, 81.82. Okay, probably not looking to have a go at these highs ahead of the CPI data, but maybe up towards 81, 82, 81 and a half kind of thing going into today. Let's look at gold. So staying negative at the sell-off, retracement, flag pattern in here, broke down lower last week again and nudging lower again in here today on the 30-minute chart now. So you can see there's the sell-offs. So you get sell-off, flag, and then sell-off in here, flagging again. Looks like for me, all the risk is back lower. Just down through the lows there, I think you just wait for the trigger through 1863. Looks more negative. And let's go take a look at the 10-year note. Staying negative, big negative in here on Friday, nudging lower today. Look right on these support lows in here. I think we flagged these on Friday. Where are they? 12.20 and a half and 12.18 and a half. The low on Friday was 20, so we went right into that support zone. And then today we're at 18 and a half. We've held right at that low there. Down through 18 and a half, this all looks a lot more negative. And then treasuries could be down here into the low 112s in here going into today, maybe even high 111s for today. And that's a 10-year note. All right, guys, any questions? Anyone got anything they want to put to me? But I think, powder dry to me. I mean, for me, the stock indices, there's probably a little bit of upside, but I think it's small, and then it'll probably come back down lower again. So, consolidation type day, thinking of it more of a chop day and a range trade day. It's going to be harder. You're going to get a lot of opportunities tomorrow. Keep your powder dry for that. A little bit clearer, I think, for gold and oil. Oil bullish, gold bearish, and treasuries in here, 10-year notes, and across the treasury board in here, staying negative. Any questions? No questions? All right, guys, going to wish you all, as ever, a great trading day. Please do take care, stay safe, and I'll be back with you with the Bull versus Bear webinar ahead of the CPI data tomorrow. Cheers, guys. Bye.